Hey everybody, welcome to the morning market briefing. It's Wednesday, August 12th, 2026. Hope you're doing well out there. Lots to get to today. We're going to open up with some confusion on capital gains tax. I think we got CPI rolling through, all kinds of good stuff. Ben, starting off with capital gains, Trump looking to make some changes. People seem to not necessarily be following the bouncing ball, but essentially looking at reworking some stuff. The question I would have is, are you in favor of this?
The capital gains side, not so much what's proposed. So basically, Trump is trying to draw up some support ahead of the midterms. He's looking at modifying capital gains taxes so that homes worth $2 million or less would be exempt, and that he would index capital gains to inflation. I think, and we can ask the accountants about that afterward, but I think indexing capital gains to inflation would be incredibly cumbersome. And I don't know who it would fall. I mean, I imagine it would fall on the accountants. It could fall on the custodians, which would be a lot for the likes of Schwab or Fidelity to process.
Yeah.
And they don't tend to adopt things very quickly.
I tell you what, it'd be hard to make decisions in real time, because then you'd be like, how much is this capital gain going to actually be?
Yeah,
right.
Yeah, it's like, should I sell this because I think inflation's going to be about this?
And do you use the revised inflation number? Do you use the reported inflation number?
We might become big fans of owner's equivalent rent being too high.
Yes.
Keep it high.
I mean, I would definitely be in favor, especially, and it would tie well to what Trump wants to do in terms of the supply side, would be get rid of the corporate income tax. Right now, corporate income tax and capital gains tax revenue is about equivalent. Get rid of the corporate income tax. It's free to do business in the United States. Get rid of the capital gains tax. Everything is ordinary income. And yes, for people who generate a lot of money from capital gains, that's not great. But I think that's something that Democrats would get on board with, or should get on board with. They wouldn't get on board with getting rid of the corporate income tax. But I think it would be positive, because then all of a sudden you'd have Warren Buffett paying the same rate as his executive assistant. So that's always been my opinion on that.
I feel like that's going to be very unpopular with our listeners. I'm going to throw that out there.
But no corporate tax. I mean, you're
Yeah.
net, you're actually not getting taxed more, because the corporations, your dividend's going to be bigger because they don't have you're not getting double taxed.
Yeah, or buybacks, or there's a number of different ways they could do it. I mean, CapEx wouldn't be such a problem for Meta, you know?
Yep. We do have, my phone is like
the Pied-a-Terre. So there was another story on the tax front. The Pied-a-Terre tax in New York City has been paused. There's a temporary restraining order on it because the city needs to make an assessment of whether the property has to be assessed this extra tax. Instead, they're just sending out tons of letters to highly valued properties saying, you should check into it. Otherwise, you could be on the hook for it. And the judge says, no, you actually have to have probable causes as a second home before charging the money.
Yeah, the big problem for me is how many of those people are just renting those apartments to other people, and how's that going to affect the affordability of prices in New York. I think that's the sneaky agenda here, is to make people sell and then have NGOs buy those properties. But that's just my tinfoil hat.
It is interesting, though. I mean, we continue to see I'm encouraged by the rate at which what seemingly more radical regulation or tax policies that they're running into logistical hurdles.
Yeah.
And it's not necessarily surprising that, okay, we can't actually figure out how to implement this, regardless of whether you like the policy or not. But the speed at which these things are getting away from us, I think, is going to be quite hampered by, wait, how do we do the thing we said we were going to do?
Yeah.
So
it's hard to seize the means of production.
It's tough. It's harder than it looks. Certainly is. CPI. Let's talk. We have a number?
So everything came in line. Month over month was 0.1. That was the expectation. I mean, there's really nothing jumping out at me. I'm looking through the numbers here. Shelter still remains high, though it's running below the headline number. So the headline number was 3.4%, core 2.5%. I mean, there's nothing really popping off the pages outside of the norm, except that the 12-month numbers are still running hot as a result of previous numbers. But
Utilities and medical care services were the hottest. I think used cars and trucks also fairly high. And then on the other hand, auto insurance was coming down, and we saw some of that from some of the insurance companies themselves saying the market's becoming a little bit tighter.
And we saw another step down in energy across the board, but not to the degree we saw last month. So for context, energy was down 5.7% for all categories. Last month it was only down 1.5%. But, that's coming off of 21, 5, 7, across the board the previous 3 months. So that's still keeping it elevated on the 12-month. I mean, shelter still shows 3.2 annualized, but we've had 2 consecutive 0.1 months. So that number should be rolling off. I mean, I just don't understand where we're going to get 3% shelter inflation. I mean, it's going to evaporate.
And utilities were high because, I mean, it was yes, July is hot usually, but this one was hotter than normal. Not only that, but you also have the data center build out going on. So you have a little bit more inflation on the utility side too.
Overall, Tom, as you think about the rate environment, does this change anything? I mean, obviously it's in line, so seemingly no. But do the underlying prints shift anything in your narrative of where you think rates are going?
No, I still think we're seeing rates tick up quite a bit this morning, just kind of across the board, nothing but green. I mean, the 2-year, which had really ticked up, I mean, it was getting close to like a 4.3, is now at a 4.19. So you're seeing the short end come down quite a bit. I'll quickly check in on interest rate futures, and no change there yet, but I expect that to change here shortly. We're still at 44% chance of a hike in September, 1 for the year, estimated to be in December. I mean, I think that the spin zone here is going to be they didn't make any progress. You're going to hear, oh, well,
inflation's still 2.4.
They've got a hike because staying firm didn't do anything. We're still here. But everything, I mean, the core ticked down 1/10 month over month. The headline ticked down 1/10 month over month. You're now seeing the stickiest piece. You've now had 2 consecutive running below the headline numbers on shelter. Oil is coming down. I mean, it's what people don't seem to understand is that hiking rates is not going to fix supply chain issues. It's not going to produce more oil. What is going to produce more oil and fix supply chain issues is by generating more supply, which is investing here, creating new avenues. I mean, think about it. I mean, the only way we've ever seen prices come down on things is innovation, investment. We talked about it before. TVs are cheaper now than they've ever been, particularly the level of advancement in the TVs versus when we were kids. I mean, we held on to TVs that were made of wood until I was in high school.
Yeah.
Because TVs were expensive.
2 men to carry them, and they were not big.
Yeah. So the idea that government intervention, hiking rates, is going to make things cheaper, I think, is a fool's errand. I mean, anything that has government fingers all over it becomes more expensive. I mean, healthcare has not gotten cheaper despite
education,
a zillion different things. Yeah, exactly. Student loans, going to college is now, I would argue, not worth the investment for most people. So I think that if we can continue to push the supply side instead of trying to modulate the demand side with interest rates, we're actually going to have a lot more success. But make no mistake about it, Timrose is going to have a victory lap. Oh, they didn't hike rates, and we're still seeing the same levels of inflation. And think about the third and second order causes. They're going to be coming down the road. 6% is almost here. I mean, that's what you're going to hear all day. But I think that Warsh is looking at this number, and he's thinking this is fine. The trend is still coming down, but what you're holding on to is higher numbers from previous months that are elevating the overall number.
I mean, in summary, what you have is commodities or goods, excluding food and energy, is 0.8%. 0.8. That's less than 2. Last time I checked. Services
Confirmed.
X energy is 3.0. So
fine.
We're more of a services economy than a goods economy. Half of that is shelter, which is 3.2. So that's dragging it up, which means the remaining services is 2.8. And a lot of that's being driven by hospital services, which is up 5.2, and airfares that are up 25%. So that's where your inflation is. Is raising interest rates 25 basis points going to reduce airline prices? No. Is raising rates by 25 basis points going to reduce hospital prices? No. I mean, we just
Is falling oil prices over a few months going to lower airline
Right,
prices?
right.
Probably. And I would love to know, maybe I'll ask Grok while we get into the next topic, what percentage of people fly on an airplane in any given month? Like, what's the monthly average users of airplanes? Because I bet there's some people who do it a lot, and there's a huge swath of this population.
There's people who've never done it.
Yeah, who very rarely fly an airplane. I mean, I certainly don't do it once a month. So how much does that affect me? It doesn't.
Yeah.
And that's supposed to be really crushing me from an inflation standpoint.
Let's jump to earnings. We've got some AI related companies just absolutely crushing it this morning. CoreWeave up 17%, SMCI up 9%, Lumentum up 8%. Big moves for these guys.
Yeah, I mean, this is not an all clear, but all three of these companies saying we can generate money in AI and even doing things in AI that should be perfectly competitive. CoreWeave, it's a neo cloud, which means they buy chips and literally rent them out. That's all they do. They spend $11 billion a quarter in CapEx, and then they rent out the chips. And they're now making a positive margin slightly. But the big thing for them is they have a longer than expected useful life of kind of its old NVIDIA chips. They were depreciating it over 6 years, but they just signed a contract with a company that'll go through 2029, which would basically be a 9-year full revenue producing cycle. And they've been raising prices on the same GPU. So if you can get rent increases in a capital
for longer
upfront, I mean, that's a huge win. Now, I don't think this is going to be sustained. It doesn't fit with historical patterns of technology. But for now, I think that it's early innings here. SMCI, they took down their guide for this quarter about 3 weeks ago, but then they just put up a crazy number for the next four quarters.
They were thinking 58 billion. Now they're saying 70.
Yeah. So like looking at 75% growth, they're also making favorable gross margins. And then Lumentum, which provides a lot of like the fiber optic cables that connects the each server to the GPUs and basically in the data center, these are the optical cables that connect them. That's performing exceptionally well as also, and they say we're just inflecting.
You've got a quote in here, and Tom, I don't know if you have the notes up, but I wish we had this as an image. There's a quote, I guess, from the conference call with Lumentum that I don't know what any of this means, Ben. But buckle up, everybody. Increasing demand for our ultra-high power CPO lasers, an initial order for ELS modules, as well as our breadth of NPO engagements, are the first signs that optics are starting to penetrate in-rack connectivity, significantly upping our optical TAM. T-A-M.
I mean, that sounds good, right?
Sounds like things are good for their total addressable market.
I mean, half the characters from Star Wars are included in that sentence. CPO.
Yeah, I mean, essentially what you used to have is optic cable going from the like big, Comcast tower or whatever it is, and connecting that to the data center, and which still exists, but now you have even on a very short
on a
rack to rack basis, the optical cable. Yeah, I mean, I think that it's very interesting dovetailing all of this with the discussion that NVIDIA had yesterday or 2 days ago with the $500 billion investment. If you think about CoreWeave, one of the reasons I think that we're in the early innings here is I think that we're in the early innings of financing these things. Mm-hmm. I've seen a few cycles of what I would call bubbles in what should be perfectly competitive markets, whether that's building out a solar grid. A lot of people were doing this, like they were buying upfront expenditure on solar panels and then renting them out and selling the power over a period of time. And they called like preferred power agreements or power purchase agreements. and then they'd have, ultimately they had a number of drop down vehicles. They had hold cos, they had yield cos, which just paid a yield, but then had the capital on the balance sheet. Then they had kind of almost your GP interest, which didn't make a ton of money until they hit a certain milestone, and then all of a sudden they got all the equity in the project. So I think that is going to come to the data centers too, and we haven't even touched that. I mean, people are still raising debt and equity. Just wait until we get into these new convoluted financing schemes. It's going to be remarkable, and that's going to take a few years. So I think we're still in the fairly early stages.
Tom, you got any data on?
Yeah. So
flyers?
Interestingly, in a 12-month period, for 2025, the number was 45% of Americans flew one time. And the interesting thing is the peak was actually 54% in 2015. I don't know why that would have been, but it's pretty much consistently between 35 and 45% all through the 2010s and 2020s. COVID, notably in 2020 and 2021, was 22 and 37%.
Wow.
And the estimate for has ever been on a flight is about 86% of Americans have been on a flight in their lifetime, but 14% have not. I mean, that's basically 1 in, 7?
Yep.
Which is pretty interesting, but it seems about right. I mean, there are definitely plenty of people who just, they have no need for or have no interest in flying.
Yeah. Interesting. So basically, half the country's flying.
Yeah.
Once a year.
Once a year. At least once, yeah. So, I mean, I imagine a lot of those people, it's like, I bet the bell curve on that has a real fat tail.
Yeah. All right. Well, shout out to the Diamond Medallion members, I don't know who you are, but you're out there. All right. We'll wrap it up there. We'll be back tomorrow. Y'all have a great day.